Good day to all. This will be our continuation for discussions involving depletion under IFRS or PFRS 6. We actually made an introduction already on this topic. Make sure to watch that. Depletion, like depreciation, is a systematic and rational allocation process together with amortization. As what we've said, depreciation is for property, plant, and equipment under IAS 16. Depletion is under IFRS 6, while amortization will be under IAS 38. And intangible assets will be discussed soon. Now, the depletion base or the depreciable amount is, of course, based on the values for the natural resource or the mineral resource, also known as the wasting assets. And just like depreciation, the allocation will be over that period of time. And that period of time is when we are going to extract the resource. However, although we said when, but it's not going to directly state that the method to be used is straight line method. No. In fact, we mentioned it's going to be the units of production method. As said, depletion base is basically depreciable amount, which is cost less residual value. Residual value again, which could be salvage value or scrap value, the value in which we can actually sell or dispose the wasting asset at the end of the life or term in which we can still extract the estimated natural resource. And because it is an estimate, it can change later on per discussions or changes in accounting estimate. Now, the useful life is normally expressed as the quantity of natural resource or number of production or similar units expected to be obtained from the natural resource, as said a while ago. Depletion will begin when natural resource starts to be extracted, and that will be based on the actual resource extracted. Now, if there has been no extraction, meaning to say no depletion shall be recognized. And it ceases when the natural resource basically has been physically consumed or no more additional benefits because we can no longer extract further resource, or when it is disposed as discussed under the recognition principles. Also in property, plant, and equipment, which is very similar to this one. Now, again, we are going to use units of production method, activity method, also known as variable charge method. And under that method, remember the depletion base, which is the depletable amount, cost or acquisition cost plus the total costs, which we will tackle later exhaustively, less the salvage or scrap or residual value divided by the number of units estimated to be extracted equals depletion rate per unit. And whatever the unit rate there would be, that is to be multiplied to the actual units extracted during the period. So the depletion charge, by the way, will not form part immediately to expense. Firstly, if that is still depletion at the beginning for the extraction, then that will be part of the cost of an asset as a product cost or inventoriable cost. However, just like inventories, the cost of depletion will be part of expenses under cost of goods sold or cost of sales when obviously the inventory has been sold. So movement from assets to expenses. Now let us apply illustration. I am going to give you a minute to go over with the question so that it will be easy for us to discuss and tackle. So at this point in time, you should be pausing this part here. And now let us continue with our problem. Take note that there is basically a list of costs that will have to be recognized from here. One of that is basically our acquisition cost or lease cost of 50 million pesos, expiration cost of 10 million, and then policy of the company is to capitalize all costs of expiration and evaluation of mineral resources. Remember, we discussed this in our discussions for depletion, is that this will be actually a matter of accounting policy developed by the company. For development costs, which will be tackled also exhaustively, if intangible, since we cannot properly segregate or separate intangible items with other assets, clearly this will be part or form part of or forming part of our acquisition cost total. Also, for the cost wherein the company will be required to restore the property to its original condition, or if not exactly at least close, will also be capitalized. So that's why we have here these items for a total cost of natural resource of 150 million pesos. Now, we also have the estimated ounces of gold of 100 million and the actual units or ounces of gold extracted. And so to be able to compute our depletion rate per unit, that will be the depletable amount or depletion base divided by the total estimated deposits. So that will be 150 million pesos divided by 100 million units equals 1.5 or 50 per unit. This is in pesos. Multiplied by the actual units extracted equals 300,000. That will be total, or that will result to 450,000 pesos. And this would be our depletion. So we have to take note that this is anyway our first entry for the acquisition of the natural resource. So debit the asset at the cost, the cash should be 145 million, but the restoration cost is to be paid in a future time, and therefore that is to be a liability for the meantime. Asset retirement obligation, or ARO for acronym, of 5 million pesos. That's a liability. And to record the depletion, that is simply to debit it first to an asset, work in process inventory. That is an inventory for goods that are still in process of 450,000, and accumulated depletion account, which is the contra current asset or non-current asset account, by the way, for our wasting assets, since they are expected to be consumed in more than a year. If current, of course, contra current asset, but this is non-current. So contra non-current asset account. Take note, this is in 20x2 because in 20x1, there has been no extraction. We can see that on the last sentence here. All right. So that's how we got it. Although there is an alternative solution of the acquisition cost multiplied by the fraction wherein we have the actual units consumed divided by the estimated one. So with that, we can see that it is 300 in 1,000 divided by 100 million. That's going to be 0.003, right? Or that is 0.3% of 150 million equals 450,000. That's okay. But I would suggest, because this is an alternative, always follow our design format so that we will not be confused. This is okay for advanced learners, or at least you're able to comprehend or understand the formulas prior. All right. And to show this on our statement of financial position, we have the cost of the resource less the accumulated depletion, and that would be our carrying amount. Okay, hopefully you got that. So I'm going to pause this, and hopefully you are pausing also in order to absorb the details into your head. Now, what if for additional requirement out of the 20,000 units here as said in the problem, what about if portion of that 280,000 were sold and 20,000 remains in inventory? As said, the sold one will become part of profit or loss or the other comprehensive income section, and or actually, so this is now called statement of comprehensive income before income statement. And of course, particularly in cost of goods sold or cost of sales. Statement of financial position will be the unsold unit. So to do that, simply multiply our number of ounces or units of gold that were sold as part of cost of sales, and the unsold will be part of inventory. So 20,000 times 1.5 pesos per unit each accordingly or respectively. So cost of sales and inventory. Although another way for this is Remember, we have 450,000 as depletion, and 280 divided by 300 is 93.3333 If we multiply that with 450,000, so we will get 420,000. And also for the inventory, 20 divided by 300, so that's 0.066666, so meaning 6.6666 dot 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 percentage of the 450,000 equals 30,000 cost of unsold inventory. That is also our alternative solution, similar to the pattern here, which is in terms of fraction or percent. All right, but then again, if you just understood the main way of solving that, you're fine or okay wherever you go. Next, as said, if there would be estimates knowing that the number of units to be extracted estimated for the entire duration of mining operations would be, again, estimated or based on estimate. Therefore, it can change over time. And also the residual value can change. And with that, we have to apply prospective application under PAS 8, which is the standard for accounting policies, changes in accounting estimates, and errors that were tackled exhaustively in conceptual framework and accounting standards. So what if there's a change in estimate? For this problem, you should be pausing right now. Kindly read this in 2 minutes. This is quite a lengthy problem, so you should be doing that as well. To solve this particular problem, we just have to take note again of our formula for total acquisition costs. So we have the total cost of 10 million, and then we also have expenditures for exploration, the intangible development costs, which will have to be included. So that's why we get actually for our cost of natural resource total of 20 million pesos. The residual value, on the other hand, we can see it here, it is at 1.2 M. But then to be able to do that, there would be costs. And so the net residual value is at 1 million. This is also the learning point here, that residual value, as we know of, will be the net of the amounts or values. So that's why we get here 1 million as residual value. And so the depletable amount or the depletion base will be at 19 million pesos, to be divided by the total estimated deposits of, as explained here in the first paragraph, of 100 million units. That would be equivalent to 0.19. So that would be the depletion rate per unit. And let's go back once again. The 30 million actual units quarried from 20x1 through 20x4, we are going to get 5,700,000 accumulated depletion, so that the carrying amount at January 1, 20x5 would be 14,300,000. Then we are going to basically compute the revised depletion rate per unit at the beginning of 20x5, since the requirement would be depletion for 20x5 and the carrying amount at the end of that year. So that's the point of doing this, because we have to compute the cost update and the carrying amount actually, or carrying value update at the beginning of 20x5 to properly compute the two. Okay, so moving on. The revised residual value, this is now a change in accounting estimate application. Here it's actually 800,000, but there is cost of disposal. So we deduct so that the net residual value will be 500,000. Now, it has also been said that the remaining recoverable reserves at that date is 25 million. Therefore, we do not make use anymore of 100 million minus 30 million, which is supposedly 70 million. It's possible that estimates can change at the end of the year to be applied at the beginning of next year. So we have here 25 million, not the 70 million update, or based on the net or the remaining, based on the previous estimate, equals 0.552. Kindly check that. Okay, it's really exactly 0.552. The depletion for 20x5 then is simply multiply it with the actual units extracted We can see that in the second paragraph, last sentence. And alternative solution, it's up to you to journalize same way. The amount now is 3,312,000. And carrying amount is whatever is the cost at the beginning of 20 million minus the accumulated depletion, the sum of from 20x1 to 20x4 of 5.7 M. So that's visible here, this one. And for the 20x5, which is 3,312,000. And this is our, for a while, this is our total here. So 9,012,000 to get the net carrying amount, or simply the carrying amount. That's our illustration 1. Next, illustration 2. What if still a change in accounting estimate, and then this is quite a unique problem. Compute for the depletion charge in 20x5. Kindly pause and read in a minute. Now to continue, we have here our problem in which, again, what is asked is the depletion charge in 20x5. This is our carrying amount. This is actually a shortcut. Again, based on the computations a while ago, I would not suggest this one. So let's do our computations. 10 million, the acquisition cost total. What is good here is that the total is already given. Divided by 50 million units, that would be equivalent to 0.2 or 0.20 pesos, meaning 20 cents per unit of extraction. Now, the total units extracted from 20x1 through 20x4 is 30 million. And then supposedly the remaining at the end of 20x4, meaning for 20x5 is 20 million units. However, at the beginning of 20x5, we have the remaining at 20 million units with extracted 5 million for 20x5, meaning at the beginning it's 25 million units. And that is illustrated here. Anyway, so with this analysis, and then I actually discussed that a while ago, but we can also do this like squeezing, and I favor this one. Squeezing is when we are going to work back and get the values at the beginning or at the start. So 20 million ending of 20x5, then we work back because we have extracted or removed 5 million. Therefore, there were really 25 million units remaining, or meaning to say at the beginning, 25 million. And to compute here anyway, that will be needed later. So simply at the end of 20x4 or beginning of 20x5, the carrying amount is 10 million, still use the original estimate, that's 0.2 times 30 or 30 million units, 30 units in millions, of course, for our respective depletion. So our depletion expense, but it's not an expense, it's going to be capitalized as cost of inventories or the wasting assets as extracted. And that would be 0.2 times 30 million units. Again, that's 6 million. 10 million minus 6 million equals 4 million pesos, which is the carrying amount. And we use that 4 million to divide to our 25 million units estimated to be extracted equals 0.16 times the number of units extracted in 20x5, which is 5 million units, equals 800,000. So that's how we got depletion. All right, so hopefully you got that part. For the depreciation of mining equipment, we just have to take note that we go back to the mining equipment discussions. But prior to that as well, we have to take note of development costs, which are the costs to develop the certain acquired property for mining operations. And to develop, we might be using tangible development costs, which are the equipment. Tangible, basically, we can perceive by our senses. We can say they have physical substance, but intangible development costs, on the other hand, would be the opposite, no physical substance. As said, intangible development costs will have to be capitalized as cost of the acquired property, while the tangible costs will have to be classified further on. It can be they are movable or immovable. If movable means to say we can literally move from one side to another, then these parts normally can be, or these development costs which are tangible can be sold separately from other assets, meaning they're identifiable. And with that, they have alternative usage. Their particular useful lives and their residual values, or the values, would not end just because of the mining operations have ended. They can still continue if they have been used, or they can still be used for other purposes. And such movable tangible equipment is depreciated over its useful life using regular depreciation policy. So it's like the PPE, and certain methods have to be used. On another hand, the immovable tangible equipment will have different ruling. So we have to take note of this. Let me go to the table. For immovable, we are going to depreciate over the shorter of the equipment's useful life and the mine's useful life, such that if, for example, the equipment's life, let's say, is 10 years, but the time that we can make use and extract resources from the mine is estimated to be 12 years, therefore we have to use the useful life. And with that, we use straight line method. So it's actually straight, obviously, straight line method. While if longer equipment life, let's say 12 would be the useful life, 12 years, and the mine would be, let's say, 8 years. So we use the 8 years and use the units of production method that we have discussed for our wasting assets. So take note, these are tangible development costs, but are just having their separate rulings. These are not our acquired property, which are, or which is basically under wasting assets or asset respectively. So for that illustration, we have the immovable tangible equipment. This is our purchase real estate, and we have the cost, exploration cost as well. Then totaling for intangible development cost 4 million, which will form part of the cost of the wasting asset. The movable tangible equipments will have to be depreciated using any method that is applicable, while the immovable tangible will have to be analyzed further on as to the shorter of its life versus of the life or the term that we can make use for the wasting asset to be extracted. Now we have to take note that the estimated recoverable reserves from the mine is 2,100,000 units, and we are estimated to extract every year of 300,000. So that is 7 years. And we compare that with the useful life of our immovable tangible equipment, but it's not here anyway. What is here is the useful life of the heavy equipment, which is movable tangible equipment, and that is to be used for whatever method is applicable. Now, case number 1, let's say that the drilling rig foundation, which is an immovable equipment or immovable tangible equipment, is 5 years, and therefore we use that for our analysis, which is shorter, 5 years versus 7 years. Because the useful life of a drilling rig is 5 years, we use straight line method. Anyway, you're asked about the depletion and the depreciation of the two types of tangible equipment. As said, for the cost of natural resource, that would be the total, and divided by the total estimated deposit. So same procedures as before here. That's 10 pesos per unit multiplied by the actual units extracted equals the depletion. And then for the depreciation of movable tangible, so no method has been used or has been explained and has been discussed here to be used. Therefore, we also use straight line method. So simply cost, no residual value. Therefore, the acquisition cost equals the depreciable amount divided by 10, 800,000. Now, for the immovable tangible equipment, it will be the shorter between the life of the equipment and the mine. So again, we compared that a while ago. Therefore, we have to use 5 years using straight line method. And the cost of drilling divided by 5 under straight line depreciation method. What about if we compare the life of the immovable or the immovable tangible equipment is 8 years versus 7 years, the life of the wasting asset or the mine. Therefore, we use the life of the mine, and the method is units of production method. 6 million divided by the total estimated deposits, that's 2.86 per unit. Normally, we round off to the nearest two decimal places if ever there's no instruction what decimal places to use, and if also it's not going to be exact. Like a while ago, we have 0.552, three decimal places, because it's really exactly 0.552. But if it is not exact, like there are many decimal places, so we use two decimal places. All right. So that will be the end for our discussions involving depletion and computation. So hopefully you learned something from this session. Thank you very much, and God bless as always.